Good morning. It is Friday, November 8th, 2019. And where did the year go? We've all been worrying about the trade war, but lo and behold, oh, I had those wrong. First, they're going to roll back tariffs. And then maybe we won't put tariffs on Europe. But 38 minutes ago, maybe not. So we're no further along in understanding what's going to happen with the trade war than we were yesterday or the week before or the year before or a year and a half ago. But maybe we do know what's going to happen because a year and a half ago, I suggested on this very webinar that China would just stretch things out, get the things that they needed to get, and ultimately not do a deal with President Trump. Or if they do a deal, it would be a fake deal. Well, I think President Trump is starting to realize that the Chinese are interested in a fake deal where they get what they want and they give up virtually nothing. President Trump won't like that. So do you think it'll happen? I'm going with, at best, we get a fake deal out of desperation from the president. But given where the newest impeachment items have gone, I'm not sure it's going to matter come January or February. The idea that 20 Republicans won't roll over on President Trump in January or February, I think is misguided. I think that there is 20 to 30 Republicans and possibly the whole party who might roll over on him. We shall see. I think a lot of these things are interwoven in ways that we don't even imagine at superficial levels. If President Trump thinks he's going to get impeached, why would he cut a deal with the Chinese? His next venture is in media. We all know that. So whether it's in a year or in 5 years, the Trumps, Donald Jr. and Donald and Eric, in particular, Jared Kushner, still don't know what to make of Ivanka. I can't figure that one out. Their future is in real estate and in media. So always consider the political actions in that context. Don't think for a minute that this is purely about America. Hate to say that, but it's become self-evident to me, and I went into this very, very open-minded. You can read my letter that I wrote a couple of years ago after I picked President Trump to win. Didn't vote for him, but I thought he'd win. So, are we going to get a trade deal? Who knows? What does the market think? After that last tweet, or that was actually a statement, the market's just kind of churning here, doesn't know what to do. Doesn't know what to do. So let's take a look at some macro. Let's take a look at the bond market. I've been reading a lot about the bond market ever since the repo issue in September. I'm trying to figure out what's going on around the world. And it seems to me that there's a lot of people on a lot of different pages and a lot of people in particular positions of power that want different things. So let's just start with the structure of the bond market. First off, bond trading has actually fallen at some of the big banks. Why? Because factor-based investing from the quants has come to the bond market. Is it good or is it bad? We don't really know just yet. We just know that they're adding a lot of the trading mechanisms to bond trading that have already gone into the stock market. What have we learned about the stock market? The stock market has become more temperamental and more cliquey, I would call it, in the last few years. What do I mean by cliquey? It means that things that are popular become much, much more popular. The homecoming king becomes class president, becomes the Rhodes Scholar, becomes the president, becomes a sex offender, right? And nothing to do with Trump there. Just Just the sort of things that we're seeing, where popularity breeds popularity breeds popularity until there is some sort of collapse in that popularity. And then you have a pariah. And in the stock market today, we're going to talk about some pariahs. But going back to the bond market, it's clear that it's become more and more fragile. We have incredibly low interest rates that don't make any sense in the context of actually creating an environment where savings and investment thrive. And I'll talk about that when I introduce a guest that we are actually going to bring on finally after Thanksgiving. Might be right before Thanksgiving or the weekend of Thanksgiving, but in that general range. Going to bring somebody on who I don't entirely agree with, but who is, once again, got the pulse on some of the things that are wrong. Some guy named Keynes said many, many years ago that zero interest rates would be bad because it would discourage investment. And it's coming to pass that is in fact true, and we'll discuss that a little bit as well. But the bond market is becoming more and more fragile. And the underlying problem with everything in the economy is what? Come on. What is the underlying problem with the global economy? Come on, somebody knows the phrase. I want to see it in the chat. Slow growth forever. And not really till forever, but a couple more decades. Maybe a few more decades, we'll see. So all these problems are structural. Larry Summers talked about it. I've been talking about it for a decade. Harry Dent hinted at it. So we have all these structural problems in the global economy. And yes, the United States is a little bit better off because of the millennials offsetting the boomers. Now, people try to show charts online, and I'm going to warn you about this right now. I see them all the time, where somebody goes, oh, look, the demographics are in the United States' favor. Again, to use a presidential word, bullshit. The demographics are not in our favor, but they're also not in our favor. The demographics are roughly neutral. The millennials are simply offsetting the boomers. So you're not going to see from 0 to 100 like you did with the boomers, because there was few people, and then the boomers came in, there was a lot of people, and that drove economic activity. As the boomers die, as they get older and spend less, the millennials are taking up that space, and it's a smoothing effect. There was already a big economy. The millennials are not going to drive that all that much higher. You need to understand this concept, and I will eventually get around to updating it. So, this guy, finance minister of Germany, says Germany doesn't need stimulus, it's not in recession, full employment, blah, blah, blah. But, are you guys getting blurry? I hope you're not getting blurry. Let me turn something off here. There we go, that should help. All right. Don't hack me. I got other software running, but that one's a hog. So, but France is growing by a whopping positive interest rate, percentage rate. Whoa, look at this, look at this, look at this. Almost 2% growth. Can you feel it? Can you feel the excitement? Whoa. Yeah. Doink. Well, what is running that's making my computer say I hate you? Anyway, so Germany slowing down, France not speeding up, just slowing down less, I guess. The pound is falling because of the potential of Brexit. You've got some fake news out there that says that Brexit was going to be magically better for Britain. And I think that someday It's going to end up being a non-event. It's another one of those things that time will smooth, because eventually Britain will just cut other trade deals, including with the EU, probably with the United States. There's going to end up being something like the Trans-Pacific Trade Partnership, because I think it's apparent after 3 years of trade war that the only way to deal with China is a united front, and rather than going it all by yourself, and somebody will fix that. So where is the money going in the bond market? Oh, by the way, finance minister says Germany doesn't need more spending, but Christine Lagarde, all right, new central bank, says, oh, yeah, we need more spending. You know, my feeling on that is I don't think we need more monetary stimulus. The world is flooded with liquidity, and that money has nowhere to go. Why? Because interest rates are so low, and everybody is hedging their bets on whether or not the Green New Deal or something like it's going to happen. Well, in Indonesia and India, it is happening. They are investing in the green economy. This is the biggest news in the world. Understand that the entire energy complex is going to change over the next 2 to 3 decades. There will be more money in renewables than in the oil majors in about 10 to 20 years, somewhere in that time frame. The oil majors are going to get crushed eventually. Now, they will spin out green energy companies. We've talked about that, and we'll want to keep an eye on that, how they structure those deals. Where do the executives go to skim money next? I mean, run companies next. Renewables get hooked up into the bond market. This is probably where the good debt is going to be. Malaysia, we have a little starter position in Malaysia. They unexpectedly lowered reserve ratio. Now, I'm a little concerned about that. With a 3% reserve ratio, that means 33 to 1 leverage, right? Just take the inverse. That doesn't take a whole lot of going bad to go bad. So we'll see what happens with our Malaysia ETF. We're sitting right around even. I think I might back out of that short term. I like this country long term. I really do. But maybe they have another leg down. We'll examine that in an article. So what happens now that the ETF world is going, or not the ETF, the bond market is going quant? What happens with ZERP and NERP, right? And Treasury rallies and Treasury collapses. and kind of funny that we're talking about a 1.5 points in either direction, right? Are we going from recession talk to reflation talk? That was the soup du jour this week, right? Soup du jour would be of the day. What's soup du week? Soup du week was this talk. Reflation next year. Reflation next year. Reflation next year in the face of a fake deal or a no trade deal. Again, we've talked about this too. We know the supply chains are moving, but that's going to take a very, very long time because it's expensive and heavy. Recession to reflation. I think that next week, or I think in 2 months, this will say from recession to reflation to skip straight recession. There's some guy out there coining the phrase skip straight recession. What it means is that we'll get an economic slowdown next year that's a little bit more pronounced. We'll probably get a quarter where we nudge into the negative territory. But the lazy man's version of what a recession is, which is 2 negative quarters, may not play out. I don't think it'll play out. But the official definition of a recession is just a general economic slowdown. We're going to get the official definition of a recession. We may not get the lazy person's definition of a recession. Hence, skip straight recession because maybe it's catchy. And by the way, speaking of notes and bonds and things like that, this guy has captured a quarter of the exchange traded note market. Super interesting to me, given that his firm is under a lot of pressure because he told a dirty joke. It was a pretty dirty joke. I don't know what the joke was, but I'm presuming there was some offense taken by somebody, probably for semi-legitimate reasons. Maybe it was very legitimate. I don't really know. I don't pay that close attention. But I know that Fisher Investments has lost billions of dollars. Fidelity pulled money. A whole bunch of organizations pulled money. So if this guy is a quarter of the exchange-traded note market and his firm is under pressure, could that cause a problem in the exchange-traded note market? I don't know. Maybe. Let's keep an eye on that. Hey, look, slow growth forever. Let's keep that just in case we need it. So we're going to be talking to Richard Field. We've already talked. And he's creating something called the Institute for Financial Transparency. And a lot of what he says is right. However, a couple of things he says are pretty wrong in my opinion. You know that I'm very pro-Keynesian. I think that a Keynesian approach to the economy has always worked and will always work. The problem is we never pay hard debts. See, a Keynesian believes in paying debts. Just use debt for good things when it's necessary or needed or wanted. But you still pay your bills. So this idea that Keynesians don't believe in paying bills is, once again, presidential word, bullshit. But Richard and I are going to have a discussion. I encourage you to follow the link here, this one on his pinned tweet. Follow this guy because he has some very interesting ideas. And Martin Wolf mentioned them, which should get your attention. Martin Wolf at the Financial Times is very, very smart. In fact, I think, just throw this out there, if you're not reading the Financial Times, the Wall Street Journal, and Bloomberg on a regular basis, you're missing out. Those are the easiest ways to see what the street signals are. And then you can go and do your research after that. But between Bloomberg, Wall Street Journal, and Financial Times, I know it's $100 a month to get them all. That's probably all the newspapers you need unless you want something local. Also, I would keep an eye on Barron's. I might pick that up once in a while when you see an interesting cover. But if you've noticed in the chat rooms that when I print to PDF an article, I am putting them in there now for you folks who don't have those subscriptions. So I'm doing the best I can to throw some of that information into the chat rooms, which means that you should visit the chat room from time to time. Also, the forum at Fundamental Trends, about ready to get rocking and rolling again with some of the new structure of the memberships over there. So, in any case, he talks about what we need to consider in the markets. And one of the things he talked about a while back is this whole idea that zero and near zero interest rates were actually going to be amazingly good for the economy. And they have been at a certain level. And I think the relationship, and I don't know exactly where Richard stands on this, but I think the relationship that a lot of people miss with central banks, and this is important right now because clearly central bank policy has hit a stall. It's less effective today than it was 4 or 5 years ago when we were, and 10 years ago, when we were in the midst of a real economic slowdown. Flooding the world with liquidity based on debt becomes a problem if that liquidity doesn't produce economic benefits. And we're getting to the point now where the economic benefits have pretty much on the monetary side started to dry up, which means that we need some sort of fiscal plan to get the economy moving again, because it is stalling out. And you might not feel it yet because you haven't lost a job, right? And we haven't had stagflation. But all the charts and all the indicators I've been showing over the last couple of months, in the quarterly update in particular, show that we're starting to hit that pause zone in the economy, which is why I've said that next year, because of the presidential cycle, right? Cycles matter. Probably going to get a slowdown next year. And if we get a slowdown that the market's not expecting, and it doesn't seem like it's expecting it right now, that's bad for the market, bad for the stock market. So we have to be careful. Now, the interesting thing is that there's a lot of stocks out there that are already depression priced. Seriously, I'm going to show you a stock today that's down 85%. 85%. And they do something incredibly valuable and are still growing. So, it's interesting what's going on in a world where people see one thing and they believe another. Remember the movie Swordfish? John Travolta, Halle Berry, right? I know there's a scene that everybody remembers, but the scene that I think that you should remember is the helicopter on top of the building. Everybody's watching the helicopter, and they don't notice John Travolta slip out the back with his team and go down a flight of stairs. Right? Misdirection. People are looking at the wrong things right now. I categorically guarantee you that is true. Why? Because it's always true. No revelation here, right? No prescience. Just a realization that most people look at the wrong things. Why? Because people want to feel good today. And because people don't plan that much for tomorrow. I don't know why that is. I've given up on that. I'll throw a little poker in here right now. So this week, I played in a tournament. I actually showed up to the wrong tournament because I've been so busy. And it was more expensive than I thought it would be. I was like, whatever. I already drove here, so I'll play. It was $260. And I qualified for the Wisconsin State Poker Tournament, state championship tournament next week, because I ended up winning this tournament that I played in this week. Right? People go into things not knowing what they're getting into. And sometimes it turns out good. And that's a lot of what's going on in the stock market. People are chasing this stock market, and they don't know what the hell they're doing. Well, it's going up, so I'm going to keep on chasing it. Yeah. Somebody mentions that the low rates have helped coverage ratios, debt service, for companies and consumers, not really for consumers, because consumers are still paying 20% on their credit cards. I mean, their car loans are 2% and their home loans are 4%, but what percentage of the population is that? I mean, people are still falling behind on car loans, even though there's no interest. But yes, absolute debt levels are basically in the same place that they were a decade ago or 11 years ago. Now, time and underlying inflation that we don't acknowledge in our formulas means that the debt load truly is not as heavy in relative terms today as it was 11, 12 years ago. In absolute terms, it is. But we have a bigger base to hold it up. So think about a cheerleading pyramid, and you have 4 cheerleaders on the bottom, and you stack 6 more on top. Okay. Eventually, they get tired and it collapses. Now, imagine putting 6 cheerleaders on top of 8 people in the base. That's basically where we're at now. Still have 6 cheerleaders in the air, but instead of holding them up with 4 in the base, we're holding them up with 8. So don't get too excited about the debt ratios just yet. At least not at the sovereign level, and probably not at the consumer level. But at the commercial level, you've got about a third of the companies in the S&P 500, particularly some of the dividend stocks and the REITs, that are pretty out there on the limb. Now, that doesn't mean the limb will break, but if you're climbing a tree, I know some of you were that kid, are you going to climb up the middle of the tree where the branches are the thickest? Are you going to climb all the way out to the edge of the branch because you want that freaking apple? Some of those companies are on the edge of those branches reaching for that apple. Why do they reach for that apple? Why aren't they managing their risk better? I'm telling you, it is as simple as this. The executives and the board of directors get paid a lot of freaking money to keep that house of cards, right, built. We're going to mix our metaphors, right, with regularity here. And they climb out on that branch because they're getting paid a check. So as they climb out on that branch, somebody's still shoving money in their pocket. Really, they're shoving money in their own pocket. And when they fall, they get a golden parachute, so they don't hit the ground very hard. But all the shareholders, all those little leaves, now they're on the ground. So don't discount greed and fear in almost everything, from what people are buying to what they're selling to how executives run a lot of companies. Not all companies, there's lots of great executives. But there's a lot of people who just believe in getting their share of the pie. And they forget to try to make a bigger pie. That's a problem in economics. That's a problem in the financial markets. That's a problem with corporate structure. That's a problem with humanity. People want to get their sticky little fingers inside somebody else's pie rather than just making more freaking pie. And ultimately, to solve the wealth inequality problems, which are starting to drive civil unrest, to create higher standards of living, the solution for the stock market, the bond market, for sovereign debt, for the general broader economy, all come down to doing smart things with the debt, doing smart things with the money, doing things that will grow standard of living. And there's no shortage of improvement that we can make in standard of living around the world and even in the rich United States. The problems out there are not insurmountable. They're not even that hard to solve when it comes to theory and practice. The problems come down to really, you got extremes driving the narrative. And all that comes back to our freaking investments. Because really everybody should be somewhat invested. Because in the long run, you don't want your labor and sweat to be the only thing that drives your standard of living. You want to take part, not just in getting a slice of pie, but having a pie that just keeps on growing. So when people talk about the cult of growth, again, it's more bullshit. You need growth to improve standard of living. So one of our subscribers, the guy who whispers in my ear about semiconductors, told me to read a book, and I ordered it before our conversation was over. He called me from San Jose. And I forget exactly what the title is. It's More from Less. And somebody wrote a book a while back, about a decade ago, and talked about how we were not going to really have a lot of resource scarcity, and I didn't believe it. And I still don't believe it, but I think that in the short run, in the intermediate last 10 years, we have been able to get more from less, especially in energy. Now, I think there's problems coming with certain materials and water in particular. So we're going to have to figure out to get more from less with water. That solution is going to be technological. At some point, we're going to take wastewater and we're going to recharge aquifers with it. And that's already happening in some places. Eventually, we're going to take the rising water levels in the Great Lakes and the oceans, and we're going to figure out how to make that water useful. And hopefully the ice sheets don't completely melt. But these gigantic trends we can't deal with quickly if we rely on the central banks to just keep taking more debt and pumping liquidity in the system. Eventually, we have to use that liquidity for productive ends. So you have your modern monetary theorists out there who are trying to get some press. Bernie Sanders, economic director, she's so full of bullshit that I don't know where to start. There's a problem with confidence. That's one of the reasons why people save more, even though the banks aren't paying any interest. Why would you save more if the banks aren't paying interest? Why? Because you feel like you need to have more in the bank because you're not getting the interest, right? It's a vicious circle. And then that money doesn't go into more productive investments. So all these things are interrelated. That's how it impacts investments. And at some point, it means that there will be a big digger in the stock market. I think the digger comes next year because we're going to have an economic slowdown coinciding with a presidential election that's got a lot of uncertainty, at least in a lot of people's mind. Not really my mind, right? I've put it at like 90% likely a Democrat wins. It's not 100%, still just 90%. So we'll see, does either party start talking smart about how to use all this money that's out there? How can you inspire confidence without building the debt more? How can you use the existing liquidity? And that's where the big investment opportunities will come from, because at some level, they'll do some of the things right. Talk a little bit about the bond market, right? And this week, gold and silver have been getting crushed last week and this week as the end of the world trade implodes. Well, the thing is that gold and gold stocks in particular were just dramatically undervalued, right? Gold stocks got crushed for a long time. If you take a look at the 10-year chart on the gold miners, this looks an awful lot like oil, right? In fact, let's overlay oil. Max it out. They all got crushed in the last 5 years. Gold a little sooner, right? I actually called the gold collapse. I called the oil collapse too, but unfortunately, I also called a gold rebound or an oil rebound. Oops, that's not working out for me so far. I would suggest this. In a world where we're slow moving on doing the right thing, and we're fast moving on emotional reaction, these trends probably reverse at some point. When? Not really sure. Could it be next year? Maybe in gold it's next year. Could it be oil and natural gas? Could be the year after. Those are the two things that I believe. I believe that gold is going to start a significant bull market in the next year or so. And I believe, and remember, I've been accused of hating gold because I said it would fall when it was up here. Right? We can put the actual price of gold here too. Right? Price of gold. Let's get rid of the oil here for a second. Right? Price of gold came down. Gold stocks came down. And there were structural problems in the market for gold too, because the miners were mining in too many places. They had too high of risks and too high of expenses. In the last 3 years, 4 years, 3 or 4 years, right in here, the gold miners, with the price of gold being lower, remember we bought gold at $10.50 at one point and then sold it, and we never bought it back. And we should have. We should have bought it back about a year ago. Such is life. But we've bought some gold stocks. We'll talk about those. But I think that this consolidation, this fixing of their business model, getting rid of their high-risk mines and their high-cost mines, paying down debt, right? It took years, which is often the case when companies have to transition or they have to fix a mess that they got into, are now ready to probably take off. So we got this rally, and now we're getting a pullback. I would suggest that this pullback in gold is something that you want to take advantage of. Yesterday, I started buying GDX for my clients at Blue Mountain Asset Management. And I do have to, because I'm a fiduciary for them, I have to make their trade before I make my trade or before I tell you. So I don't own GDX yet, but my clients do, and now I'm telling you. Why? Because it looks like this pullback is pretty darn short term. Right? Getting down to the oversold area. MACD flipped over. Price came down. Look at the weeklies. Right? Not a whole lot of weakness here. There's still big money that wants this. So there's a significant buy the dip mentality among big money probably. Right? It's just not coming down that far. Now, interestingly, it's still pretty close to about as low as it goes. So you're closing in on a reversal here. Now, does this reversal come in a day or two? No, probably over the next 4 to 8 weeks. If you go back to the turtle traders, we know that most transitions and trades take a month or two, and then the trend will last for 6 months to a couple of years. This upward trend lasted about 6 months. So we're going to get our month or two of getting beat up, maybe 3 or 4. And the downtrends in a strong market typically are much shorter than the uptrends. So even if this lasts for 4, 5, 6 months, which is possible, I think you're starting to get good prices. Over at Elliott Wave, and this is one of 3 technical guys that I follow. I follow Avi and a guy named Zach. I subscribe to their services. And I don't need you to go out and learn Elliott Wave theory, but if you want to get super in-depth in technical analysis, you need to do like 3 or 4 things. This would be one of them, I think. Projecting out GDX all the way up to 50-ish. But I think that that's the tip of the iceberg. I think GDX probably can quadruple in the next 4 or 5 years. 4, 5, 6 years. So I don't think the upside is a double, which is what this chart shows. I think the upside is way out here. Add a couple more years on this chart. Zach showing that the pullback price is about 26, maybe a little lower. This chart is from a couple of months ago. This is a September chart. So he was telling people back in September, when the price was 30-ish, come back to about this line. 26 or a little lower. And look what it did. It's come all the way back to about 26. I think this is a good spot to take a nibble of GDX if you're an ETF investor. Remember, you probably already own Newmont because we got very involved in Newmont down here. So mind your asset allocation. Then we have our junior, right, core mining, which we really got involved in here, right, from about here all the way through here. So we're, you know, again, I remind you, most of our picks, ex oil, have been pretty damn good. So now CDE is breaking out, right, going through that resistance right here. Why? Because as I told you, I understood the business. I tried to tell you, and I wrote about it. Silvertip, their mine, is important. That mine is going to be massive cash flow positive for them. So when you take a look at some of their key stats, you notice, well, they only have 250 million shares outstanding at $6, right? So not a real big market cap. That Silvertip mine is going to add a lot of money to their bottom line. They got a price to book ratio that is going to change. We'll see how fast the price goes up, but the book value is going to go up, right? So, no, we were not acquiring CDE at $8 a share. You might have. I told people all along, get down to right around $5 a share. Got a little lower. Right? So when we get into these companies, we want to understand them. This is clearly a stock that if you understood it, even if you bought up here, right? Even if you, I don't know anybody who bought at 8, to be honest with you. Yeah, I could see some people buying in here. I think my first purchases were in here. But then when it got down here, you had months and months to study the company. Should have understood Silvertip. I took you to that pond, you just had a drink. You knew that that was going to generate free cash flow. So now we have people doing some serious accumulation of this stock. Right? Now, I wouldn't be buying core right here just yet, because it does look like it's going to get to that overbought spot. But can it run all the way up to 7 or 8 right now? It could, right? And you have to decide if you want to take the risk of it falling back to 5. So the upside right here is probably $2. The downside is probably $1. Is that worth it to you? I can't tell you that. The other gold miners, the other juniors, a lot of speculation in here. I generally stay away from these guys because I like the fact that Newmont and Barrick have consolidated like 70% of the industry. Give me the oligopoly leaders. Give me the ones with monopoly pricing power and all the money. Yeah, you can find a speculative home run in here. We might have found one in core. But this whole great big group, tell me the 2 or 3 that are going to be the big winners. I don't know. I just don't know. I mean, you can apply factor-based modeling to these, which I do, and you're still going to have a hard time trying to figure it out. So ultimately, to figure out which 1 or 2 or 3 of these, look, Core's not even in here right now, and they're going to need to be. You got to read an awful lot of corporate reports to figure out who probably in this industry has added a mine. And that's why I liked Core, is because I saw they did something different. They acquired a mine at a time after they had done some financial retrenching. You've seen a lot of that in the energy industry right now. Companies that have been spending 2, 3, 4 years retrenching are engaging in mergers and acquisitions, not just getting bought out by the majors, right? They're planning for a long-term future. And, we know that the long-term future of oil and gas isn't as long as it used to be. But they're merging. You have companies that are merging, and, one of those mergers looks like it's all screwed up. Chesapeake looks like they messed up. But Encana, they look real good. So we'll see. For anybody who's still holding Chesapeake, it looks like they're going to do a reorganization, which means that the shares will end up being worth pennies or nothing. And the bondholders will end up owning the new shares. Or private equity will take over that company. It'll be a take private. And I've told you that there's going to be some take privates, and Chesapeake might be one of them. Why? They still have a lot of valuable assets. But it's gotten to the point now with 5 years of low oil and gas prices, gas in particular, which is 75% of their mix, they just couldn't overcome it. McClendon got them out over their skis, and rather than landing on, whatever the downhill portion of the slope is, they overshot the slope and looks like they're going over the cliff. They'll still land, but they might land with new shareholders. So I'd be real careful with Chesapeake at this point. I am incredulous that what's gone on took so long, that they got beat up so bad. I lost 70-80% of my money on that one. It was only a few percent, but still, I got my ass kicked. Yeah, now the thing is last year, so early last year, we sold all of our Chesapeake stock. That was the recommendation. And I said, if you want to speculate, buy some calls. And the calls went up initially, so, we did sell, I told people to take some profits. But then what's left is freaking worthless. So that's where you have to make the decision, am I lazy or not lazy? Am I greedy or not greedy? I think people miss a lot of trades. And again, I'll equate it to poker. In poker, you miss 1 or 2 bets in a tournament, you ain't going to win. There are 1 or 2 calls and 1 or 2 bets that turn an entire tournament, and then there's luck. But, with Chesapeake, yeah. They Salazar, what was Salazar's name over on Seeking Alpha? He's got his own little firm now. It wasn't, I forget his name. But anyway, he said 3 or 4 years ago that Chesapeake probably goes bankrupt. And he understood something that I didn't understand, which was that if this oil and gas slump lasted so long, the companies that were gas-focused and had a ton of debt would never be able to get back. And so Chesapeake kept trying to become a more oil-focused company, but they're only going to be up to 26% oil next year. If I'm Chesapeake, I probably do a reorganization, and as part of that reorganization, I probably sell all of the oil assets and try to create an incredibly low debt or no debt natural gas company. That's the way I thought it would turn out, except that I think maybe there has to be a bankruptcy included, which I didn't expect before. So let's go to another natural gas company that we're in. This stock, Antero, is down 85%. So the natural inclination of people to say, well, is this going to go the way of Chesapeake? And the answer is probably not, but you should understand the differences in the companies. One, these guys have all of their assets in Marcellus, which is mainly West Virginia, and then in Eastern Ohio. So they don't have to then deal with Pennsylvania or New York, and they're in 2 states very friendly to their operations. That's important. It's one of the reasons why I say stick with the Texas oil companies. They're friendly. You don't want to be operating in enemy territory. These guys are in friendly territory. The gift of good geography, like the United States has, compared to the rest of the world, right? This is the best geography in the world. Hands down, nobody else compares. We have everything, and it's safe. For a shale gas or shale oil producer, these states are both pretty good, and some of these states are pretty good, right? So they're in a good spot. When you take a look at their third quarter presentation, they get straight in. The very first thing they show is all the cost reductions that they're having. They're going to save $250 million between this year and next year. So cost per well is going down. They are not going to spend any extra money next year for drilling, and yet they'll still grow a little bit on production. So if you're in Antero, you want to understand this stuff so you can understand what to do about it. Read their quarterly report. It's not that long. Just the press release is fine. But the bullet points are important. So they're increasing full year production guidance, but their debt's coming down, right? Their hedging is doing well. And like I said, the summary here is pretty good. They're saving money on water and transportation, cut better pipeline deals. And so Antero Midstream was the partnership that was structured under them that ended up going Dallas Salazar. Yeah, Dallas Salazar had Chesapeake, right? I'm going to have to send them a note. The midstream company here, they changed the structure, and Antero owns $1.4 billion worth at this point of that company. That company also is dramatically undervalued for the assets that they control. Now, we got into CenturyLink a little too early. And again, it has nothing to do with the value of the assets or the operation of the company that the price went down. It's just that sentiment is making things more extreme. And we've been talking about this for all year now, is given a more extreme sentimental emotional market, maybe that's because millennials are younger and they're taking over the market, you have to play the edges. Avoid the middle of the market. So where is Antero? Are they in the middle of the market anymore? Right? From 9 to 8 to 7 to 6, you didn't hear me say buy it. But now we're down at $3 a share. I'm starting to think that we're getting to the point where maybe we should add some of this under certain circumstances. One, do you want to speculate that the company is going to overcome their debt obligations in 2021 and 2022 with gas prices rising? I think that the smart way to handle this is let's see if President Trump weakens further or if he gains strength, right? If that 90% probability of him not being the president becomes 50%. And then we should ask, does that even matter? After the next election, does it matter if oil and gas prices go up? Think about it this way. President Trump probably going to want to repay some people. Probably lets the price of oil and gas go up. Can't get reelected a second time. So he has a motivation to keep oil and gas prices low through the election. After that, no such motivation. And we know that the Democrats will make it harder to drill, particularly offshore and on public lands. And then gradually the EPA will get more teeth. So I think that companies like this one, where they're in good places, they're in safe places, and they've gone through that period. You know, we talked about it earlier with the oil and gas companies and the gold companies. They've gone through a period of belt tightening and restructuring. Still have the assets. I think Antero is a company that if you think they're going to get over their debt obligations in 2021 and 2022, so you need to study that, take a look at the cash flows. I think they will, but it's not a guarantee. I thought Chesapeake would get over their problems too. You know, but this is at $3 a share. You got to start thinking about it. So if you have a commitment to this company already, and you have a cost basis of 10, which is where ours was, you probably average in. Now, I've taken tax losses on this, and currently I have no position in Antero. I believe that I will have a position in Antero again, but I had to do some things for clients, and now we have to decide who is going to have this stock in the future, which accounts. So you have to take a look at your situation the same way. Does it make sense for me to have this? I will say the upside here is probably to get back to around $10 a share. So when you do all the math, and I'll write an article on this, $10 a share is probably what the company's worth. Does that mean the stock price will ever reflect that? Again, why oil and gas prices companies are priced for Armageddon? Read the article. Maybe, no matter how much these companies are truly worth as companies, maybe the shares, which are publicly traded and subject to sentiment and emotion, maybe it's never reflected ever. One of the problems with Chesapeake wasn't that their business model completely failed and the price of oil and gas stayed lower for longer. It's that their share price never allowed them to do the swaps that they needed to do. Had their share price been 10, they could have swapped out a lot more debt. But swapping out at $3 and $4 a share versus $10, $9 and $10 a share, right? That's triple the debt they could have gotten rid of. They'd have been down to about $6 billion in debt had their share price been 9 or 10. It's a big difference. $3 billion difference. And that's why Chesapeake's probably going to fail. These guys don't need to swap debt. But they do have to be cash flow positive. They have the ability to repay their bonds coming in 2021 and 2022. The banks could squeeze them. Right? Maybe the banks decide they actually want this asset. And that's a worry. That's a concern. Bottom line, it's not a no-risk stock. But if you want to take some risk, it's probably got about 400% upside from here. But it could also could also have to do a reorganization. Probably not, but it's not a zero probability. All right. So we had some other questions. I'll leave these up here just because I can retag them. Somebody asked about Sierra Wireless. So Sierra Wireless isn't growing as fast as we thought they might. That's largely because of the automotive industry hasn't taken a hold yet. But take a look at their projections for the type of business that they do. The business that they do, the type of business, the industry is going to grow about tenfold in like the next 5 years. The interconnectivity of the cloud and edge computing and devices. It's going to grow about tenfold in 5 years. Why? Because of all the cars that are adding autonomous driving features. Not only the EVs, but the hybrids, and pretty much everything. Even your gas guzzling Cadillac is starting to drive itself. At least drive itself a little bit. So as 5G takes hold and we have the almost no latency communication, and you have multiple different ways of connecting things across different networks with different devices, these guys are one of about a half a dozen companies that have a solution. So no matter where you are, no matter how fast you're moving, no matter what you're using, you get that communication. You get that signal. All right? So that is something to keep in mind. At what point is this a buy? Well, I've been selling puts again. This break probably was uncalled for, but smart money knew, apparently, right? Because this never went up. But this is actually largely retail driven. They just sold off. Got that big dunker down the other day on earnings. Down 28 cents. You put in money flow, right? The money flow was not horrible. Then it fell off a cliff. Right? It just fell off a cliff. That means somebody pulled out a big hunk of money. And there's no way that was just retail. It started to go back up, and then it fell off again recently. My guess, this looks like to me, because this was strong for a while, and then it suddenly in the last month fell off. To some mutual fund, somebody who owned a significant position figured out or got information that they were going to have to retrench their numbers, and it fell off. Maybe a hedge fund was shorting it. I don't know. I haven't taken a look at the short interest. I'm suspecting it was very high. So that's something to take a look at. Take a look at the short interest. Is it starting to go away? The short interest is starting to go away. That means it will probably get some consolidation and then a rally. Then this gap will have to fill. Because clearly this is a consolidation range. So this gap is going to fill. I think you can sell puts on this. There's downside to around 6-ish, 5-ish even, according to Elliott Wave. Candlesticks, point and figure aren't so dire. But given that emotions and sentimentality are driving these stocks, it could have another dink down. So if you own none of it, I would probably nibble just a little bit. If you already own some, I'd wait to see if you get the dink down, right? And if it rallies back up and fills that gap, you already made that money. So I wouldn't average in here if I do own it, but I would potentially sell puts at these lower prices, or wait until we get down to in the 6s, right? I don't know that it's going to go there. Nobody does. But again, given how emotional markets are and people sell losers, it creates more losing, and they buy winners and creates more winning until you hit an extreme where it can't be done anymore. I don't know if we're at that extreme just yet. I mean, look at this RSI on the daily. And where is it? It's on the weekly too, though. I got to sell some puts here for me, because I'm willing to take the premium and get an average price around 7. It's up to you if you want to do that. But don't fall into the idea that somehow people are really analyzing the fundamental information, because they're not. This is all sentiment driven. This is all emotions. Your job is to understand the company and try to figure out where the emotions can't hurt it anymore. At what point is your heart broken so badly that it can't break anymore? I think we might be there with Antero, and we're getting close with Sierra. Maybe we're there. Hard to know just yet. Occidental, somebody made the statement that people are worried about the dividend. Yeah, whatever. People can justify things however they want to justify them. This is another case of a hated industry for all the reasons we've talked about. And you got a guy like Carl Icahn who's talking bullshit. This company is so well positioned for the future that as long as they continue with their divestiture plans of their international assets and non-core assets, these guys are going to be in great shape. Their debt just keeps coming down. They just keep turning out cash flow. They're in CO2. They're getting into solar. They were smart enough to sell that overseas, the export facility. They flipped it. If you're a real estate investor, think about how they flipped. Occidental flipped the export facility, oil export facility down in Corpus Christi. Bought it, fixed it up, sold it. Right? We should have a cable TV show, flipping oil export facilities. Right? We found this beat up oil export facility that didn't have a deep enough port. So we bought it on the cheap, and then we built a deeper port and we shined it up. Slapped a new coat of paint on it and a couple new in and out things, whatever the hell those things are called. And then we flipped it. Made $1 billion. Yay! Nobody loves them for that. And they're criticizing the management. People who are ripping on Occidental just don't understand the company. And I will say that most people who rip on a company don't understand the company. Learn the companies. Read 40, 50 hours a week. That's what I do. Now, I know you have jobs. You can't do that. So you pay me for. Occidental is going to be fine. How low can they go? I don't know. Could they get down to 20? I mean, shit, maybe. All right, let's take a look at the questions in here. Pattern Energy. Yeah, I don't know much about them. I don't know much about the Canadian stocks. I follow them. Somebody asked if we should sell CHK stocks now. I mean, I haven't owned Chesapeake stock in a year and a half. I told everybody in February 2018 sell Chesapeake stock. Yeah. Again, I just want to correct people. People's concerns about companies don't matter that much. Those are just narratives after the fact in most cases. Sometimes there's validity. Study the company, decide if there's validity. Right now, oil stocks just get beat up because they're oil stocks. In Occidental's case, Icahn is crying because they went to Buffett for cash and they messed up his takeover play. He wanted to see Occidental get bought out. I get it. And then he was a bitch. Is it crazy to think 7%? It depends where you bought. Generally, you want portfolio positions of 1 to 6%. You start with 1, go to 2, sometimes 3 or 4. Accidental is 4 something percent for me. Marin, I have not gotten to their call yesterday. What are they doing today? A good reaction or a bad reaction? I mean, I read a little bit. Yeah, people just piddling it away. So here's the thing with Marin. Like I said, when some of us bought a little share of this, is that it's a speculation stock that if they can capture some market share in what they're doing with digital advertising, being a solution for people who have to try to spend their money online, which is everybody now, right? It's a huge market that's not going to stop growing for a long time. I'm familiar with the billboard companies. I'm familiar with television advertising and radio advertising. I've got friends and people I know that are in all those industries. I'm telling you, everything's going digital. And Marin, if their product becomes one of the favored products, their software as a service could be really, really explosive. And here's the thing. The company's got a $12 million market cap, right? This is as small as it gets. If you invest in these guys, you're investing in 2 guys in a garage. That's what this is. It could absolutely go to 0. They might be better off just taking a job with a bigger company. But they haven't shown that they want to do that. You take a look at the shares outstanding, right? If all of a sudden these guys are generating $50 million in revenue instead of 11, and in that market, it doesn't take much to do that, right? I think they probably have to cut a partnership deal with somebody. The stock could go from 2 to 200 very quickly because there's just not many shares outstanding. This is set up, if they're successful, to go up 100-fold. But it could go to 0. There's no doubt about it. So you don't need more than you don't need a lot of this in your portfolio. You buy 100 shares here and 100 shares there, when you've got a couple $100 laying around. I still think SunPower is going to 100. They are the commercial leader. Think about what's going on in California. It's all you got to focus on, what's going on in California. And the rest of the world is gravy for them. They're part of the solution in India and Indonesia. We mentioned that at the start. I didn't mention SunPower. I just showed what's going on there. So SunPower, if you already own it, depending, your cost basis is probably 6-ish, right? If you want to add more, right? If you want it to be a 4% position instead of a 2% position, sell some puts or buy. If your account's not big enough to do that, just add a little bit, nibble in. Oh yeah, okay, yeah. A lot of these oil and gas companies are going to go private. I'm convinced of it now. And we talked about it for the first time, 4 or 5 months ago, 6 months ago, I don't remember. But yeah, sentiment is going to drive these companies private, a lot of these companies private, because the public is too dumb to understand that they're going to be valuable for a long time. And there's no way, even Elizabeth, you can't just say fracking's illegal, right? That'd take an act of Congress. And the lawsuits would be epic. What the president can do is forbid new leases offshore, can prevent new drilling on public lands. And what's going on the public lands right now under Trump is that the companies that have public leases are drill baby drill on those public lands right now in case it has to stop in a year or 2. They're using up the acreage. So it's not going to matter. And then they still have the private land, which is 78% of where all the oil is or something. So a lot of these things are inconsequential. It becomes a matter of finances and oil. The finances are working their way through the consolidation and fixing period. If Chesapeake goes bankrupt, that is ironically incredibly positive for a company like Antero. Think about why. Chesapeake's the 4th biggest producer of natural gas. So, yeah. So remember I said that I thought Brazil was being optimistic about what they could develop offshore? Yeah, their leases aren't going all that well. I think did Total buy something on the cheap? I can't remember who bought what. Exxon maybe got a little. But wasn't it some weird, like 80% of the lease blocks didn't get bid? It was something. Yeah. So, all right, there you go. This was a very long call. Let's call it a day. I think things are going pretty well. We're going to talk about seasonality next week, because if we get this rally at the end of the year that I think we're going to get, it'll be a chance for you to do some things with your portfolio. Take care. Have a great weekend.